Hey everyone, and welcome to this supplemental video. And in this video, we're going to be talking about a kind of cool topic, and that is negative interest rates. So, through the course of this class, we frequently mentioned the zero lower bound for interest rates when we're talking about, the Fed funds rate, the discount rate, etc. However, is 0% actually the lowest bound that the Fed can set for interest rates? And the answer is no. Interest rates can theoretically go negative. However, the big question should be, this is just a hypothetical, right? This could never actually happen. And to get a better answer on this, let's look at the US IOER, so the interest that we pay on reserves, and then the Fed funds rate. So the IOER, remember, started in 2008, and this graph starts it on 2016. So we're looking on the interest rate on excess reserves went to about 2.5% and is now back to about 0%. So we are not paying banks right now to hold on to their excess reserves. We want the banks to loan them out. Same thing with the Fed funds rate. The Fed funds rate right now in the US is about effectively zero. So this is what we call the lower bound on the Fed funds rate, where you can basically take out as much money from the Fed as you want. The Fed will loan you as much as you want. Now let's look at the IOER equivalent for the European Central Bank, or the ECB. Interesting. So let's go over a couple definitions here. First off, the deposit facility rate is similar to what we have in the US for the IOER rate. Now, it is important to characterize the differences between European central banking and American central banking. While the IOER was only developed in 2008, the equivalent in the ECB is actually the primary tool for policy making. So the Fed funds equivalent there is not the same significance to the ECB. Now, the EONIA rate is the European equivalent of the repo rate. And then the 2-year OIS rate is a 2-year interest rate swap. So you're making a reciprocal, a swap agreement on some sort of floating rate. In this case, they use the 2-year OIS rate, where the floating interest rate is always tied to the EONIA or the Euro STR. Now, let's go back up to this graph now. Notice 0%. They have been below 0% in the ECB since 2013 for the deposit facility rate, and that has brought down the EONIA and the 2-year OIS rate below negative. And we're not, or below zero. And we're not just talking, flirting with 0%. We're talking about in the beginning of COVID, we're going to negative 0.5% on interest rate. So you have to pay the European Central Bank to deposit excess reserves with them. So, when we talk about negative interest rates, this is a real conversation worth having, because right now in the Eurozone, the European Central Bank is requiring banks to pay them to hold on to their money. Uh, and that, so when you hear about the concept of a zero lower bound, this is a concept kind of the past. We've never gone to that in the United States, but it is available. And the immediate question you should all be asking at this point is why? Why are the ECB rates negative? And so the idea is to prevent banks from holding on to money, which means that they have to inject it back into the economy. Uh, in reality, all that you're doing when you're requiring banks to pay to hold on to reserves, you're saying you're lowering the cost of loaning out funds, because the opportunity cost of holding on to money is higher than before. Banks will still hold on to money, it's now just more expensive. But there are problems with this concept in the Eurozone. In the Eurozone, banks, of course, are not in turn charging negative interest rates. So if you were to have a savings account with a European bank, you're not going to pay negative interest. And so this is a profit mismatch right now, and it's causing some friction in European commercial banks. So what they have really done is they've dropped basically all account rates near zero in turn, which is, remember, actually the objective of the ECB. So that part is actually good. However, it hurts the consumer that wants to store value in their bank. Additionally, these banks, these commercial banks, have gotten creative with other ways to increase their profit margin by increasing like transactions fees, access fees, uh, laying off employees at the banks to streamline costs, etc., to try and make up the cost of money. They've also increased minimum deposit thresholds, things like that. So basically, these banks are feeling their profit margins crushed because even with the negative interest rates, they are still not finding ways to loan out all the money, especially during COVID. And so, in order to counteract these profit margins dropping, they have done some, we'll call them innovative ways to increase their profits. And when we look at the European, the ECB, it's not just ECB, so matters dealing with the ECB that have gone negative. If we look at Germany government bond yield. So remember, Germany is part of the Eurozone. We're dealing with countries that use the euro. Uh, the German government bonds, the equivalent of like a T-bill, on a 10-year bond, they are also being dragged down to negative because in Germany they use the euro. So if you were to take out a treasury bond equivalent in Germany, you would actually end up losing money if you held it to duration. Now, people still buy bonds, German bonds, and the idea is that you're hoping that interest rates rise and you can then sell it for a profit before it comes to maturity. And so it just is kind of a game of hot potato to see who ends up with the losses. And so let's now talk a little bit more in depth about the justification for doing this. First off, we're trying to penalize banks for not investing. This is explicit punishment. Additionally, it needs to have some sort of enforcement mechanism to try and get these banks to invest. Now, on the flip side, we have found out through the process of dropping these rates below zero, because this used to be this like doomsday scenario for market skeptics that only macro theorists ever could come up with. And the big fear was that there would be cataclysmic consequences, that the banking sector would just go under, that they would refuse to take on any sort of deposits, etc. And we found out that's really not the case. Interest rates uh, are negative in the past, are negative now, and it's not conceptually thinkable that they may be around for a long time. And we really haven't seen any significant consequences. It didn't trigger any sorts of problems that these economists warned about, so it doesn't seem like it's the end of the world to keep them negative when necessary. Additionally, this is proven for like the U.S. theoretically that there wouldn't be any sort of long-term consequences if the U.S. decided to ever drop the Fed funds rate below zero. Now, there are some problems. First off, it weakens the currency's strength. So the euro has dropped in strength compared to the dollar. Now, is that a bad thing? Well, that depends, because remember, it does make it more favorable for foreign investment when the currency weakens. It also has cut these profit margins for the banks quite a bit. Now, is that a good or a bad thing? That's a whole separate ethical discussion that we're not going to get into in this video. But now, in wrapping up, is this going to happen in the US? And the answer really in the short term is no. The big discussion about whether or not we should go negative on interest rates occurred in about September of 2020, when it became apparent that we were going to have the possibility of a second wave. When the Fed funds rate was near zero, we already had all these lending facilities opened up. When we'd already passed the CARES Act, we'd already given the stimmy checks, and we were still going to have continued problems. This seemed like one of the only tools available to the Fed. And the fact that the Fed didn't drop the Fed funds rate below zero uh, really indicates that, at least under the current board of governors, it doesn't seem likely we would ever see negative interest rates. However, if you do ever read an article about it, don't dismiss it. It is certainly in the arsenal for the Fed, especially if we are to see long-term consequences for the extremely aggressive open market operations the Fed has had during 2020, we see out of control inflation, rising debt, etc. This may be a more appealing option in the future to try and avoid these types of consequences. But it would require a significant recession. And so now let's talk about how would this even work. So remember, at the very beginning of this video, I prefaced it with the fact that we're talking about the ECB equivalent of the IOER. And so the ECB does not legislate through the Fed funds, their equivalent of the Fed funds rate, but their equivalent is at 0% as well. So you're basically looking at flipping the policy tool. So we would look at the Fed funds rate to go negative, which basically just means that we would see a huge surge in the availability of an eagerness to make loans through like the repo market. The same thing, because when the Fed funds rate goes negative, these banks are just going to hoard in all the cash that they can and immediately try and loan it out and make a profit off of it. So theoretically, it wouldn't be some calamitous market endeavor. It would just really end up meaning that the repo market would dramatically increase in attractiveness for these banks to loan into. So that's a good discussion. If you have further questions, please let me know and we can talk about this concept further. Just kind of a cool little tangent since we talk about the zero lower bound quite a bit.